Hi, everyone, and welcome to this month's monthly financial chat. It's really, really nice to have so many people joining us live. And for those of you watching later, I hope you enjoyed your afternoon. I'm going to go ahead and share my screen and get us set up so that we can get going. I also have the chat window open in front of me. So if you would like to send a message either privately to me or to the entire group, feel free to make liberal use of the chat video. I will keep an eye on it as we are going through. So today is Monday, October 12th, and it has been a few weeks since we caught up. So I have missed you tremendously, and thank you again for submitting so many delightful questions for us to cover today. We have a whole lot of random things to talk about, and we will get through as many as we can. And of course, this is being recorded, so definitely if you would like to listen to the details later, you'll be getting a copy of the recording in your inbox, as well as a copy of the slides. So, as I mentioned, it's October 12th. Happy Indigenous Peoples Day to those of you acknowledging that. And for the rest of us, let's keep going. If you don't know me, I am Elaine. It's lovely to meet you. I am a CPA, and all of my work is with creative organizations and individuals, making me the luckiest money person of all time. I love doing these sessions because they give me nice access to some questions that are floating around out in the world that people are having. And I think it's always helpful to share some answers to those questions because this stuff is overwhelming. But of course, this is for educational purposes only and not tax, legal, or accounting advice. So today, we're going to very quickly go over the current status of COVID-related assistance. It's a quick update because basically there's still a lot of chaos and nothing really official. But we're also going to spend some time talking about planning proactively for the rest of 2020. Since we're in October, it's a good time to start thinking about where your numbers are going to be for the year, and also touching on some unique issues that are coming up this year, like is certain emergency aid taxable, for example? Is your unemployment taxable? We know that is. And what happens if you've moved to a different state or city because of the pandemic? What does that do to your tax situation? So we'll talk about all those things. And then we also got one or two questions about planning proactively for 2021, especially in the context of uncertain income, because there's still a whole lot of question marks around a whole lot of things, even looking forward to 2021. So we'll touch on some of those answers as well. So the first question is, will there be another stimulus? I have no idea. If you have been listening in for weeks or months, you've seen a version of this slide before, which basically is occasionally updated with new legislation that is introduced. And there is still a whole lot of distance between where the House of Representatives is and where the Senate is. Who knows what's going to happen? Everybody has been sort of speculating, and that's one of the more popular parlor games right now. It is possible that there will be agreement among Senate and representatives for some sort of common relief bill. Treasury Secretary Mnuchin has been involved. The talks he's been having with Speaker Pelosi have been off and then on and then off again and now on again. And the executive branch has been weighing in as well for support and then opposition to a bill. So we have no idea. It's also possible that there will be smaller pieces of legislation that will target kind of one thing at a time. I know the airline industry was certainly hoping for this. They wanted some targeted relief before they had to lay off 30,000 or so individuals as of October 1st, but that did not come to fruition. And Speaker Pelosi is fairly opposed to this because she's not interested in doing sort of piecemeal legislation, but rather providing support to everyone that needs it. But that's still a possibility. It is also possible we will see more executive orders. You may recall there was an executive order adding $300 per week in unemployment from the FEMA source of funding. All of that has been fully expended by now, but that did come about by redirecting some FEMA dollars via executive order. And we had that executive order that paused payroll tax withholdings for Social Security and Medicare through the end of the year. That, of course, is not so great because you still have to pay in that Social Security and Medicare starting in January. So if that's affecting you, set aside those dollars. But it's possible we'll see more targeted executive orders. And it's also possible that absolutely nothing will happen. There's a lot going on in Washington right now, and we are in the middle of confirmation hearings for Judge Amy Coney Barrett, and also an election cycle. So no relief is certainly a possibility. All of which is to say, I would not plan on an additional stimulus if I were you. If it happens, I think that would be great and bring relief to a whole lot of people, but I would not put that in my budget at this point. What you can do right now is think about where you are and where you will be for the rest of 2020. And the activity I've been encouraging people to do is basically to kind of sit down and look at your income and expenses for 2020, and then look at how that compares to a normal year for you. Because for some individuals, their income has been higher than normal. And for some of those individuals, their expenses have been lower. So if you are someone that regularly travels a lot or has a lot of deductible travel expenses, but your income hasn't really changed or has even gone up, you may be in a scenario like scenario 3 here, where your net income might actually be higher than normal for the year, which means you might be in a position to pay additional taxes. And if you don't want to do that, there are some things we can think about if that's your scenario right now. For other individuals, they may have lower than normal income, and their expenses may also be lower, or their expenses may be higher if they have needed to invest in additional protective equipment, or maybe additional cleaning supplies before you shipped things to clients or something like that. So your net income for the year might be lower than normal and possibly even negative. So if that's going to be your scenario, we want to make sure we're aware of that and taking some steps to protect yourself going forward. So give yourself time to go through this exercise. It's going to be a little weird, especially when you start digging into sources of income, which may include PPP funding. It may also include the EIDL payments or funding you may have received. It might include some emergency grants. And as we'll talk about in a second, whether or not those are taxable makes a difference here. So we want to look at your numbers through the lens of just money, right? Money that has come in, money that is going out, but also through the lens of taxes. Because if your income will be higher, but it's mostly because of income that is not taxable, that may affect some of the choices you're making. But if we're looking at this from a tax perspective, and if you are expecting to have lower than normal taxable income for the year, there are a couple things I'd love for you to pay attention to. Number one, you definitely want to be keeping great records, especially if you are going to have a loss. This is true all the time, but I think it's especially true now because there is a whole lot of aid flowing around, both federal aid through the CARES Act and also state and local aid, which suggests to me that we will probably see a small increase in audits of how those aid dollars were spent. That could be an IRS audit, or it could be an audit from your state or local officials, or even through the Small Business Administration. So you definitely want to have good records of a couple of things. Number one, the fact that you are still in business, right? So what were you doing to continue to operate? Were you still applying for shows, or still writing, or still updating your website, taking virtual meetings, all of those things, right? To show that you were still actively engaged in the business. And we also want to have pretty good records around what you did spend money on, especially if you spent any of those federal or state or local aid dollars on things. We want to just make sure your records are tight and clean and nicely organized, right? Also, if your net income is going to be lower, we want to be paying really close attention to your cash flow, because we want to make sure you're in a position to still pay the expenses you have to pay. So that means we'll probably be doing maybe some cash flow modeling to look at what your expenses are and to see how much cash you have on hand to cover those expenses. Very similar to the type of planning we were doing way back in March when this all started, right? Also, if you're going to have a loss or lower than net income than normal, you probably want to think about reducing your expenses where you can. But I'd encourage you to reduce your expenses smartly, right? Unless you are in a really serious financial crisis, you probably don't want to cut all of your expenses completely, but you do want to be very deliberate about the things you are paying for to make sure they are helping you move forward in your business toward your creative goals. And we also probably want to think about timing. If there is any ability or flexibility to push expenses into next year, that might be a good choice for you if your net income is going to be lower than normal this year. The deductions might be more effective for you next year instead of this year. If that is not a possibility, that's okay. But if you do have any flexibility when it comes to timing, that's maybe something you want to explore. If your net income is going to be higher than normal, it's a little bit more fun to strategize for this scenario. But basically what we want to do is make sure you don't find yourself in a position where you have a larger than expected tax bill, right? So a couple of things you could do to reduce that potential future tax bill is definitely to think about your retirement contributions for this year. If your net income, especially from your business, is going to be a little higher than normal, either because things are still okay for you or because you don't have all those deductions you might normally have, like travel expenses, then we want to find some new deductions for you. And contributions to an IRA or to a SEP, which is the simplified employer pension option that's available to self-employed people, those could both be really good options for you. The IRA contribution limit is $6,000 unless you are an older individual who has those catch-up contributions to make. And the SEP limits are a percentage of your net income from self-employment. So maybe spend some time, if you are looking for extra deductions, thinking about what those contributions might look like for you. And you also have the ability to think about the timing of certain expenses. If you are in a position to maybe prepay some expenses, that's not a terrible strategy. This could be, rent for your business for January of next year. If you prepay it in December and you're a cash-based taxpayer, that'll give you a smidge of an additional deduction in 2020. If you have other subscriptions, whether it's Final Draft or Adobe or any of the other sort of platforms you might use, if you wanted to prepay for a year of that subscription, that would give you a deduction in 2020. Now, you wouldn't have that deduction in 2021, so think about that as you're planning. But it's an opportunity for you to essentially accelerate some of those expenses into this year to basically increase your deductions, so your net income can be lower or on par with where it normally is. And then if you have even more flexibility than that, it's not a bad idea to think about investing in the business right now, whether that means redesigning your website or updating your security or, updating that old piece of equipment that you've been meaning to update for a while. If you have those types of things that have been kind of getting punted and punted and punted to future years, if you're in a position this year where you are looking for additional deductions, now might be a good time to think about some of those things. Now, I mentioned making contributions to an IRA or a retirement account through a SEP or something like that. One of the questions that came in was about sort of the craziness that's happening in the stock market right now and what feels like a disconnect between the stock market and what many, many, many individuals are experiencing in their everyday lives. And of course, the subtext is, should I be investing in retirement right now if the market is way overvalued, or if it's so insane, I can't even begin to predict it? And I appreciate this question so much for a couple of reasons. Number one, it gives me a chance to talk very briefly about income inequality in our country, which is totally and completely evident by this disconnect, I think. But more importantly, it gives me an opportunity to reference Kai Ryssdal, who's the host of Marketplace on NPR and just a delightful human. And he says over and over and over and over again that the market is not the economy, which is true. And we see that right now, maybe more than ever, although my historical knowledge is somewhat limited here. But it really feels like there is a total disconnect between what many individuals are seeing in their lives and what the stock market is doing, because those two things are not the same thing. So here's what we do know. It is always and never a good time to think about investing. And that's true because you will never, ever, ever perfectly time an investment in the market. We also know that interest rates are really low right now. So that means anything you have saved is not earning very much interest at all. I am not saying invest everything because you will make more money, because that would be crazy, right? But we do know that lots of people are thinking about this because they're looking at their bank balances and saying, gosh, shouldn't this be better for me, right? So interest rates are really low right now. Other people are looking at that and saying, you know what, that means it's a good time to refinance my house or maybe refinance other debt I might have to take advantage of those lower interest rates. And that's something you can think about as well. We also know that the long term is a really, really long time. And you probably know what your goals are when it comes to thinking about investment. If you're thinking about your retirement and you're in your 30s or 40s, you have a long time before retirement is a reality. If you're thinking about retirement and you're in your 60s, you have a considerably shorter time. So I would probably not at all be thinking about making aggressive investments right now if I were very, very close to retirement. But if I were investing for something 20 years from now, regardless of retirement, I might make a different conclusion, or I might reach a different conclusion. So all of those things are important to think about, right? Because the context matters. If you are a very, very long-term investor, you might not care if the market is overvalued right now because it'll be a wild ride regardless. If you're a more short-term investor, you might reach a different conclusion. I will also note two additional things if you are looking for other types of investments that have different pros and cons. We know that minority-owned banks could really use some capital right now. So if you are someone who's sitting on a little bit of money and you're saying, you know what, I want to do something productive with this money, but I don't really want to invest it for whatever reason, you could always move some of it to a minority-owned bank and let it hang out there instead, where it can be supporting that particular financial institution. You can park it in a certificate of deposit or even just a savings account, and that is an option that might help you feel like you're doing something productive with your funds, even if it's not investing it in the market. You also may look at some municipal bond options. Depending on where you are located, states and cities sometimes will issue municipal bonds. As we look out into the future, I think it's pretty clear that our states and cities are going to be suffering financially for a minute. So if you are someone that feels very strongly about the strength of your own city or state and how resources are allocated, you may want to think about investing in a municipal bond. The interest on those bonds tends to be tax exempt, but it's not tax exempt if you're investing in a different place, right? So pay attention to that. But then also know that that will be a relatively predictable stream of income in the form of those interest payments. And that might be a way for you to earn a little bit more than you might make in a savings account, but not take on the risk that you would take on by pursuing equity investments. So it is always and never a great time to invest in the market or to think about investing, because the market is not the economy, and there are some things you can think about if your gut is telling you, nope, I am not buying anything right now, and that's okay. So one of the questions that came in that I loved was thinking about longer term planning, especially if, you're okay right now, and okay might just be sure about your situation. It doesn't mean you have to be thriving. So if we look forward to 2021, I would suggest it's a really good time to start that budgeting process. So think about what your expenses are going to be. They may have changed. You may have moved, you may have taken on a roommate, or you may have lost a roommate. You could have all sorts of different things going into your expenses. So get a sense of what they are looking forward, and know what they are, or as close as you can to expect what they will be. And then figure out your break-even point. If you are a visual artist and you know your expenses are going to be $1,500 a month, how many pieces of art do you then have to sell to cover that? And if your world is more complicated than just selling one thing, then spend a little bit more time going deeper. What does that look like in terms of gallery sales, or sales of prints, or sales of merchandise, or some other sort of sale you might have? Maybe it's wholesale through a bricks and mortar retail shop or something like that. Spend some time going deep into your potential income sources and figure out how many of those things or projects or pursuits you will have to complete and sell to then cover your expenses, right? And when we're talking about expenses, I'm probably talking about personal and business expenses here. And then if you look at those numbers and you say, yeah, no problem, I feel very confident that I will be able to sell 8 works in the first 6 months of 2021, you're probably done. You need to think about marketing and do some planning and, maybe build in a contingency, but you're probably done. If you're a performing artist and you say, okay, I know my expenses, and I also know that there is very little chance of me having any performance income for the first 6 months of 2021 because all of my venues have closed or have introduced new limitations that doesn't make sense for me to meet. Maybe then you say, okay, what does that mean in terms of my teaching income, or my sales of digital music, or my composition work for a commercial that I sort of wish I weren't doing, but it's still something I'm happy to pick up here and there, right? You go down those rabbit holes, and then you might figure out that, okay, even if I max out my teaching schedule, which is not a guarantee, that's not going to be enough to cover all of my expenses. So then we look for other sources of income. We essentially fill the income gaps, right? So that might mean seeking out other work, other forms of support, basically kind of exploring what other options you have. And if you do not have any other options, then we need to go back to that expense line and see if we can curtail or limit our expenses anymore, right? Because basically what's happening here is we're just looking at money coming in and money going out, and we want whatever's coming in to fund whatever is going out. And if it's not going to, then we essentially are in a loss position. So we're spending more than we're making. And that's okay, right? That probably feels familiar, especially in a year like this. But that extra money has to come from somewhere. Either it's coming from your savings because you are spending some of your savings to essentially supplement your lost income, which is perfectly fine. That's why it's there. Or it's coming from debt. This is what's happening if you've taken out a loan, not a PPP, because we all expect that to be forgiven, but maybe an EIDL from the SBA that you're planning to pay back over 30 years or fewer if you want shorter modeling, right? Or it could even be credit card payments. If you're finding yourself not being able to fully pay off the entire balance on your credit card each month, and you're watching it sort of grow and grow, you are basically using loans from the credit card company to make up that difference between what's coming in and what's going out. And again, sometimes that is the choice we have to make. But I want you to be making that choice on purpose and fully aware of the long-term implications of that, because you're going to have to pay it off eventually. It's also possible that that difference is being supported by others, right? Maybe you have someone else in your household who's contributing and sort of making ends meet. Maybe you're getting loans or essentially payments from friends or family or others around you. All of that is okay, but I do want to make sure you're clear about kind of how that's working and make sure that you're acknowledging kind of the human conversations that are happening around that, and make sure everybody is still on board with that, because we don't want this to turn into a situation where there's growing resentment or anything else sort of building over time. But the point is, as you're planning for 2021, and as you're looking at what your expenses will be, which you probably have a good-ish idea of, not a perfect idea, but a good-ish idea of, and what you think might be reasonable from an income perspective, which you probably have less certainty around, but can still spend some time kind of working out and doing the math to figure out what you would need it to be, then that can tell you if you need to be looking to cut expenses or find additional sources of income or reevaluate your plan for how you're funding those additional expenses. Okay. While we're thinking about additional expenses, let's talk about taxes, because the question is coming up increasingly: is your emergency relief taxable? And what we're talking about here are sort of emergency grants you may have gotten. We don't know for sure, but we think, and we have a pretty good idea, that that emergency relief will not be taxable to you. And here's why. There's a section of tax law called Section 139, and it excludes qualified disaster relief payments from income. That means they're not counted in your taxable income. They are excluded, which is nice, right? If you go through some sort of emergency or disaster and you get some relief from the Red Cross, it's nice that you're not taxed on that money. Because President Trump declared a national emergency related to COVID on March 13th, most experts believe that any payments or emergency assistance associated with that will qualify for this Section 139 treatment. So governmental relief shouldn't be taxable, and most people feel pretty comfortable agreeing that that's going to be the case. What's less clear is if it is emergency relief that came from a non-governmental entity. So like maybe a nonprofit organization, maybe it was a community foundation, maybe it was even some sort of private individual. We think, and I'm saying that hesitatingly, we think that those other payments, maybe not from individuals, but all the other ones, right, probably won't be taxable either. But we don't have any sort of authoritative guidance that we can point to yet to say, yep, you're all good, none of that will be taxable, it'll all be excluded from your income. We don't have that authoritative guidance yet. And as I've had conversations with different funders and asked them, all of them are working under the assumption that this is not going to be taxable to the people they have given relief to, but they're not willing to say that in writing yet because they're waiting for some guidance as well. So as you're thinking about this, it's probably an okay assumption to say any emergency relief you got is probably not going to be taxable to you, but please, please, please keep paying attention, because if we do get any sort of clarity, I will absolutely let you know. And it's something you should be paying attention to, just because it might have a pretty substantial impact on what you're thinking about, especially as you're planning for the rest of this year and next year. When it comes to that emergency relief, especially if it is going to be excluded from your taxable income, you can bet there will be a whole lot of audit activity around these dollars, right? Especially for CARES Act dollars that may have gone from the federal government through the National Endowment for the Arts, through your state arts council, through a nonprofit, and then to you, right? There's probably going to be a lot of auditing happening around that. And that's okay, right? Because you have been paying attention to your records and recording things you've gotten, and then also tracking your expenses. Because what these audits are going to be looking for is basically they're going to say, okay, if you got an emergency relief grant from this organization and you got one from this state arts council, are we sure that you didn't spend those dollars on the same expenses, right? So let's pretend the only qualified expense you had was studio rent, right? And let's say your studio rent was $500. If you got a $500 grant from organization A and a $500 grant from organization B, and you reported that studio rent to both organizations as what you spent their dollars on, that's going to be a problem. That is double dipping, right? You're basically, the money's going somewhere else because you didn't spend $1,000 on studio rent, you only spent $500. So those are going to be the kind of things these audits are looking for. So to the extent that you have records showing what you spent that money on, that is going to help you sleep well at night. And I will say as well, it is very possible that in the chaos of these moments happening, you had a grant and you spent it on something that wasn't a qualified expense. And the terms of the grant will tell you what you were allowed to spend the money on, right? So if you needed groceries or toilet paper, you may have spent the cash on that because that's what you needed at that moment. But as you're going back through all of your records, right, what your job is to do is to figure out what your expenses were that were ultimately funded by that grant, right? Because if you spent some of those actual dollars on groceries and toilet paper, but that enabled you to then have other dollars to spend on those qualified expenses, that's something that your accounting and tracking can sort of help explain. So the bottom line is, record everything, right? Record what you got, keep a list of all those sources. If you want to sort them into taxable and non-taxable, that would be like a pro move, but it's not a bad pro move to make. And then also record what expenses you covered with the different relief you got, just to make sure that everything is clear, so that on the off chance that any of these organizations ask you questions, you'll have the answers ready to go. Now, PPP forgiveness is a slightly different animal. We're going to talk more about PPP forgiveness in a few more slides, but the general working assumption is that PPP forgiveness will not be taxable. But again, stay tuned, keep those excellent records, and pay attention to the potential state tax implications of PPP, because even if it's not taxable at the federal level, there's a little chatter around whether or not it would be taxable at the state level. I think that would be a terrible idea, but I don't get to weigh in on these things. So keep paying attention to that. And then separate from emergency relief, which would be like an emergency grant you got, it's worth thinking about if unemployment is taxable. And this one is easy. Yes, your unemployment is taxable income. And as you've been getting those unemployment checks, your state may have been withholding taxes, which would be a really good thing. And if you don't know, go ahead and check. Just look at some of your statements to see if taxes are being withheld. If taxes are not being withheld, and if you are still collecting unemployment, you can ask your state to start withholding right now. It probably won't be enough to cover your entire tax obligation, but it might be better than nothing. Otherwise, you can think about setting aside some money to cover your tax obligations. The amount really varies. It could be as low as 12, 13, 14, 15%, or upwards of, 28, 29, 30%, depending on what state you live in, what city you live in, your normal income tax bracket, all sorts of other complicating factors, right? It depends. But what I would suggest is on your state's unemployment website, you remember they probably have one of those guides to unemployment, and it probably won't talk about pandemic unemployment assistance specifically, and it may not talk about sort of unemployment in this year, but there is going to be some sort of general guide to unemployment. Indiana's was pretty easy for me to find earlier today. It's just a 2-page PDF file from the Department of Workforce Development. And Indiana said, you know what? We withhold 14% from unemployment when people ask us to. It's 10% for federal purposes, 4% for state purposes. So that could be a good starting place too. If you go to your state's guide, you can see what they would normally withhold so that you can set aside a little bit. Because again, you don't want to be surprised next year when you file your taxes. Okay, another question that has come up in a lot of different contexts is about if you have been working from a different location. So maybe you're normally based in New York, but when the pandemic hit, you left and went to go stay with friends somewhere else. And maybe that is in New Mexico or a different state. Or maybe normally you're in Philadelphia, but Philadelphia was feeling a little too claustrophobic, so you went to a more remote area of Pennsylvania, right? Whether or not you moved from city to city or across state lines, if you have been working in a different place, this could have an impact on your taxes. Also, this can have an impact if you are an employee of someone else. So let's pretend you live outside of a city where your office normally is. And so normally you would have those city taxes withheld because you're working in that office. But if now you're working from home and maybe your company is saying, you know what, work from home forever, there could be some tax differences between where you physically are and where your office is located. So in a perfect world, you would not end up paying taxes twice, right? And in theory, you shouldn't owe taxes twice, because if you're paying taxes in one place, there should be an offsetting tax credit in the other place so that it all sort of works out, or at least so that you get credit for taxes you paid somewhere else. But as we know, our systems aren't always designed to keep up with what is happening in the real world. So if you have moved, temporarily especially, but also if you have moved permanently to a new city, to a new state, or to a different taxing jurisdiction, you probably will end up having to file in both jurisdictions. And in theory, you shouldn't owe twice, but who knows what might really happen. My advice to you would be track the days you have been in different places. And also note if it was a permanent move, like for example, you were in New York and you said, okay, I'm never going to be comfortable living in New York again. I'm going to move to Chicago, right? If it is a permanent move, track that. Or if it was a temporary move where you said, okay, my lease was up and it was a good time to escape from the city, so I spent 3 months staying at my friend's place in upstate New York, right? And then I went back and got a new apartment, right? We would call that a temporary move, and you would want to track that as well. But definitely keep a list somewhere of where you were, whether it was for temporary purposes or permanent purposes, and get a rough estimate. Some might say an exact number, but at least a rough estimate of how many days you were in those different places. Because when you are filing your taxes next year, your accountant or TurboTax or whatever platform you're going to use to file will need that information to help determine where you need to file. So go ahead and start putting those records together now so it won't be too annoying next year. The follow-up question is often, since I've been working from home, I get all these extra deductions though. And no, unfortunately, you don't. If you are an employee of someone else and you have been working from home, so let's pretend, you have a part-time job as an administrative assistant at Chase Bank, and they have been asking you to work from home doing customer service stuff. And you had to buy an extra charger for your Chase computer, and you had to buy, a new chair for your home office and all that stuff. None of that stuff is deductible because you are an employee of someone else, and unreimbursed employee expenses are not deductible to you. That was a Tax Cuts and Jobs Act change from at the end of 2017. So if that's your scenario and you have a W-2 job and you have some home office type of expenses, not deductible to you. If you're self-employed though, different scenario, and all of the regular rules apply. So make sure you are paying attention to that exclusive and regular use of your home office space, especially now, and especially if maybe you had a teaching job where you were an employee and you also have a studio in your home where you make and sell work, but maybe your teaching institution asked you to teach from home. It would probably be a good idea to not do that in the studio of your home, which you're deducting because you are using it regularly and exclusively for your business purpose. It would make sense to have a different area within your home where you are doing work for your employer. So just file that away and know that it is complicated, and you can check your days in different places, and hopefully keeping track of it will make it not too atrocious next year. Now, I know many of you had PPP funding that you received, which is amazing, and most of you have probably fully spent all of that PPP money by now. We have been waiting for a very long time to apply for forgiveness of that PPP loan, because remember, it's technically still a loan until you apply for it to be forgiven and essentially treated like a grant. So lots of banks at the beginning of October started accepting and processing those forgiveness applications, which is fantastic. However, many financial institutions were only accepting and processing applications for PPP loans that were above $150,000. The reason for this is because some of that legislation that was introduced in the House and the Senate included a blanket forgiveness option for any PPP loans that were less than $150,000. Now, as we know from the beginning of our conversation today, all of that legislation is still a big question mark, but the banks don't want to do the work to process the forgiveness of these relatively smaller loans if it's going to become automatic. So many of them are focusing their efforts now on those larger PPP loans, right? So depending on what your bank has said, you might be waiting in sort of this limbo, right, to see if you will need to apply for forgiveness at all and how you can do that. So most of the individuals and organizations I work with have PPP loans less than $150,000. So many of them are still in this holding pattern because their financial institution won't even accept their application for forgiveness yet. So keep waiting. Except that on Friday, the SBA released a new forgiveness form. It's called Form 3508S. And if you've been keeping track, this is at least the third forgiveness form we've looked at. There was the first one, Form 3508, and then there was the simplified version of it, which we spent a whole day kind of going through that application. I think that was July 6th. So if you want to go back and rewatch that video, that was in early July. And that form was 3508EZ. This is a new form, 3508S, that is specifically for PPP loans of less than $50,000. Now, this is the SBA trying to basically work around Congress's delay. We know that Congress is thinking about doing blanket forgiveness for anything under $150,000, so banks are waiting. The SBA is saying, gosh, that's kind of annoying for these small people or people who have received small amounts. So here's this special form for them that basically just asks for all of the basic information and then asks them to certify that they met the requirements. You have to initial a statement, and then you're essentially done. I have only reached out to one bank to see if they were accepting this yet. And because this just came out on Friday, they kind of laughed at me because they were like, no, we're not there yet. But it might start becoming a reality soon. Now, this doesn't help anyone whose loan is between $50,000 and $150,000. And a lot of organizations fell in that category, and some individuals may have fallen in that category too. So if that is your scenario, this doesn't help you. But if you had an SBA loan of $10,000, $15,000, $20,000, this could be a fast track way of getting forgiveness. I have the forms and the instructions linked here if you want to pull them up later. This is what the form looks like, at least the top of it. If you sat through that earlier conversation around for the easy form, filling that out, this looks really familiar because the top is almost exactly the same. And that's pulling information from your original PPP application. What's special about this form is this first authorization here, where you basically initial that you complied with everything for the PPP program, but you don't necessarily have to show the calculations. So, that might be a little bit easier, and that's certainly something you could think about. So if your bank starts accepting this, amazing, you can move forward. If not, you're still waiting. I'm switching gears again to this sort of bigger conversation around pivoting online or other changes to your business models. I know we talked about that early on, and there were some immediate reactions and then some slower and more deliberate reactions. And now, as people, especially creative people, are looking around, they're realizing that there may be ongoing opportunities within this virtual space, and that might have permanent implications for your business. So as you're thinking about this, I'd encourage you to think about sales tax, finding an audience, and valuing your work. Not necessarily in that order, but those are definitely three things that could or should immediately come to mind. Depending on what you sell, your things may or may not be subject to sales tax. Generally, if we can touch it, if it's tangible personal property, it probably is subject to sales tax. Although, pay attention to different state rules, especially in the state where you operate, because even things we can't touch, like digital music downloads, for example, are sometimes subject to sales tax. So think about what you're selling and figure out if it is subject to sales tax in your state. If it is, get your vendor registration form or your license, vendor's license, sometimes it's called, any sort of number of names for this form that basically allows you to collect sales tax on behalf of your state and send it into the state. Pay attention to those deadlines and go ahead and comply with them. And make sure you are charging your customers for sales tax as well. Some people prefer to do business in sort of flat rounded numbers. That's okay, but just make sure your flat rounded number includes sales tax. If you're also making sales to other states and or other countries, by the way, you may or may not be required to collect and remit sales tax. If you are selling to another country, you probably don't have to worry about it. But if you're selling to another state, you may have to think about your existence for sales tax purposes in that other state. And this is thanks to a Supreme Court ruling called South Dakota v. Wayfair, where South Dakota wrote a law that said online sellers who had 200 or more transactions or $100,000 of sales in South Dakota were automatically subject to sales tax there, even if they had never been in South Dakota. So those thresholds, again, were 200 transactions in the state or $100,000 of sales to people in the state. And with that particular law written, anyone that met those thresholds was subject to sales tax in South Dakota. Wayfair sued. Wayfair did not win that case, and the law was upheld. So now a lot of other states have adopted similar statutes. Now, it is my hope that all of you will have more than 200 transactions and more than $100,000 of sales in every state, but that might not be your reality yet. So I would say pay attention to that transaction number, especially if, say, you are a musician and you are selling downloads in a state like Ohio, where digital downloads are subject to sales tax. It might be pretty easy to hit that 200 transaction threshold for digital downloads of music, or sales of prints, or sales of other sort of lower cost tangible items that people may purchase. That is a relatively low threshold to meet, and it might not be anywhere close to $100,000 of sales. But go ahead and pay attention to that if online selling is going to be a regular part of what you are doing. And we can have a longer conversation about that if it makes sense. But the other important thing about this conversation is, as you're thinking about changing or adjusting or pivoting slightly what you do, the real value of what you do is something that's worth articulating. Your unique value proposition is something I talk about a lot, but it's essentially your strengths and then a summary of what you do, how you do it, and for whom you do it. And the context really matters, because what you do probably hasn't changed, and your strengths or your skills probably haven't changed either. But how you do it, how you deliver that value, and who you serve may have changed pretty dramatically, especially if you are serving new markets or new states or new individuals virtually. So think about what has and has not changed about what you do, and get really clear on this so that you can evaluate new opportunities and reach and identify new audiences. Because we are going to need you to continue to do this incredible work and to continue to creatively think about delivering your value to the world, especially if we are all going to come out of this on the other side. So today we had a whole lot of updates on current COVID legislation, and then we talked a lot about planning proactively for the end of 2020, including about things that may or may not be taxable and what that looks like, and additional strategies you can think about as you're looking at your own numbers, and then thinking more long-term about long-term changes to how you provide the value you provide, and also budgetary planning for 2021. So I will pause here. I have a couple of private messages in the chat. Thank you for those. I appreciate that. But no additional questions that I see. So I will pause in case someone is still typing or has additional questions they want to make sure we address. And then if not, we'll go ahead and wrap things up on this lovely autumnal afternoon. And then I will look forward to answering future questions when they come up. Yeah, quick question from Ellen. Absolutely. You can unmute yourself if you'd like to share it, or you can type it and I will read it. Either way is fine.
Hey, how are you?
Wonderful. How are you?
I'll start my video so that I'm polite. Oh, I'm in the dark, but all right, wait a minute. Okay, so I'm in Rhode Island now. I gave up my apartment, but I don't consider myself a Rhode Islander. I'm looking for a job. What do I do about the New York unemployment they were sending me? I didn't recertify the last few weeks because I don't want to commit fraud.
Right.
But I'm technically not a New Yorker, but I'm technically not a Rhode Islander. What am I?
Yes. Do you consider yourself temporarily staying in Rhode Island until you figure out what your next steps are?
Yes.
Okay. In that case, I think it's probably fine to continue to basically have your mail forwarded to this temporary place where you are, including your New York unemployment, right? Because that was tied to employment you had in the state of New York. And so basically forwarding it to your temporary address seems fine to me. I think things change if you get a permanent job in Rhode Island.
I get a job. I mean, it was tiny little unemployment.
Yeah.
It wasn't a lot of money. My accountant said he didn't think it's a problem because I will be filing a New York tax return.
Right. Agreed.
So he said, as long as they get their money, they don't actually really care.
Right.
But I don't want to be a fraudulent person sitting in Rhode Island, abusing New York's goodwill.
Right, absolutely. But I think for me, the key was you said you're not permanently moving to Rhode Island, you're just temporarily there while some question marks get sorted out with respect to your job and other things that are going on, right? So I think viewing it as claiming your New York state benefits as a longtime New Yorker and basically having them forwarded to a temporary address feels totally fine to me. And
I mean,
as you said, you'll be
bank
firing.
account.
Yeah.
One more tiny question.
Yeah.
If I get Rhode Island health insurance, I'm currently using New York health insurance, but I wouldn't mind being able to, go to a doctor occasionally. Would that make me more of a Rhode Island resident?
Probably. Yeah.
Okay.
Yeah.
So
I don't think it's a deal breaker, but I think it probably would, if you're looking at the overall facts and circumstances, that would be in the Rhode Island column.
okay. And so I don't have a Rhode Island ID or anything of that nature. So probably I'm just out of luck.
With respect to healthcare?
No, unemployment. Healthcare, in Rhode Island, I can get, from my father's address. So that's
Gotcha.
not a problem.
Yeah. But in terms of Rhode Island unemployment, yeah, probably.
Yeah.
Yeah.
Well, okay. I mean, it was a pittance.
I know.
But, even a pittance is nice. So
you should still get your pittance, in my opinion.
Okay. Thank you. I hope you're well.
Thank you, Ellen. I am. And it's lovely to see you. I'm glad you're well too.
Yeah, you're living in Indigenous people city now, I guess, huh?
I sure am. Yes. And every year there's a small movement to rename the city that gets a little bit of attention. But, nothing's happening right now. So.
Okay. Bye.
Thanks, Ellen.
Thank you.
Are there any other questions before we wrap things up?
I don't have any questions.
All right. Well, thanks, Amy. Thanks, Kay. Thanks, everyone else for joining. It was lovely to see so many familiar faces again. And I will look forward to seeing you again next month and answering even more of your questions. Be well until then. Bye, everyone.
Thanks, Elaine.